Okay, so here we go with margin. So there's going to be 3 or 4 margin questions on your Series 7. They're pretty straightforward. And so, like I say, you just don't want to freak out as it relates to margin. So, boom, let me go grab this. Let me go find you. There you are. And boom. Can you see my screen?
Yes.
Boom. Okay, so prior to 1934, Charlene, we as broker dealers were in charge of credit extension to our customers. That was called the Roaring Twenties. Everybody had great fun. For example, in the Roaring Twenties, I'd lend you 10 grand. You put up 10 grand, I'd lend you 90 grand to purchase securities. At the end of the Roaring Twenties, there was a crash. And we decided that maybe broker dealers aren't the best decision makers about credit extension to customers. So we took it away from broker dealers in 34 and we gave it to the Federal Reserve Board. The Federal Reserve Board is in charge of extension of credit in the securities industry. You correctly identified that as Reg T. Reg T is the Federal Reserve Board, and they say that initially customers must be at risk for at least 50%. They can raise it to 60%, they could drop that to 40% if they'd like. But right now, Reg T is 50%. They also establish securities that are not acceptable as collateral for a loan. So, margin requirements. So, a margin account uses leverage. Leverage is financial speed. And so, the thing people need to understand about leverage is the same supercharged speed you make money with is the same supercharged speed you lose money with. Let's say that you and I both buy a house in the same subdivision, same floor plans, as like as two houses can possibly be. And I pay 100 grand, you pay 100 grand. And I say, how did you, Charlene, capitalize the purchase of your home? I think the best analogy is a home, right? Market value of the home minus mortgage on the home equals equity in the home. You said, Dean, I put down 10%. I said, okay, so you put down 10, you borrowed 90. I paid cash. I don't have any mortgage. Homes go up $10,000. Both of us would make $10,000 if we sold the home, right? We both sell the homes for 110. Dean makes 10 grand, you make 10 grand. The difference is I put up 100 to make 10. I made 10%. You put up 10 to make 10. You doubled your money. Woo! Now I should warn you, the same supercharged speed you make money with is the same supercharged speed you lose money with, right? If homes go down 10%, your equity is wiped out. So this is financial speed. Financial Federal Reserve Board, we said regulates credit. That's testable. It's part of 34. Margin is the money required for the transaction. I haven't had a chance to explicate this question for this student, but as a test taker, Shirley, he's struggling with the difference between a margin requirement and a margin call. So if I'm a margin
Okay.
clerk, I say, listen, you bought 1,000 shares at 40, so you need to be at risk for 20. I see you have $3,000 laying around, so I need 17 from you. The call is the difference between what you need and what you got, right? So money required for the transaction. Marginal securities can be used as collaterals for loan. This can be a very, very competitive loan. For example, Larry Ellison likes to use his Oracle stock as collateral to borrow and make investments. And Morgan Stanley is more than happy to lend Larry billions of dollars because he's got 2 billion shares of Oracle stock. Not a problem. So we can lend you money to buy eligible securities. We can lend you money to buy NASDAQ securities. If you have them fully paid for, you can borrow against them. Now I'm dating myself, but I go way back. I go back far enough where banks and brokerage firms weren't the same places and weren't allowed to be the same places. Up until the early 90s, you couldn't be a bank and a brokerage firm. You could either be a bank or you could be a brokerage firm, but you couldn't be both. Anyways, one of my clients went to the bank to get a loan. His name is John, Charlene, and he came back and told me he got turned down for a loan. I said, John, how in the heck did you get turned down for a loan? And he said, Dean, they asked me if I had a job, and I said I didn't. They said no job, no loan. I said, well, John, who are you talking to? Like the teller or a personal banker or something? I mean, did you tell him you don't have a job because you're rich? And he goes, well, no, they didn't ask that. I said, well, John, you've got $10 million worth of fully paid for securities with me. I'm more than happy to give you a loan of $5 million. He goes, what's the loan approval process? I said, you're approved. He goes, what's the monthly payment? I go, there isn't one. All right. He goes, what's the interest rate? I said, broker call plus. What are the banks going to charge us? I said, hey, before you take me up on the offer, though, John, I would go back and tell the banker that if they won't give you the loan, your broker will, based on the collateral value of your stock account. Anyways, he came back, he was, oh my God, Dean, it was so different. They introduced me to this guy called a private banker and gave me a cup of coffee and showed me this big oak room. All right, there we go. A very testable know what I can't lend you money to buy. So you say, hey, Dean, I missed the IPO allocation for the stock. It's now trading in the secondary market. Go ahead and pick me up 1,000 shares on my margin account. I say, Charlene, how long ago did it go public? You say, does it matter? I say, it does. You say, I went public 2 weeks ago. I said, you're going to have to do it in your cash account. You're going to have to pay in full. You say 6 weeks ago. I go, not a problem. So new issues are ineligible securities, not marginable is the way we say that. You're going to pay in full. Now, remember, in an open-end mutual fund, we're continually offering new shares to the public. New shares to the public. And I just said new issues we can't extend credit on. Now, if you've had this mutual fund in your account fully paid for 30 days, then we will accept it as collateral. And then we don't lend you money to buy options. You want to buy a call or buy a put, you're going to have to pay in full. Very testable to know the additional documentation required to open a margin account. We need a credit agreement from the customer, mandatory, saying you, Charlene, understand that you're borrowing money and you're paying interest based on broker call. We need you to sign the hypothecation agreement. That's the fancy word. If I go into, the pawn shop and say I want to hypothecate my Rolex, that just means I want to pledge it as collateral for a loan, right? And that means if you don't fulfill your obligations, we're going to sell you out. Your securities are in street name, the name of the broker dealer. That's mandatory. We say, Charlene, we have other customers who wish to establish short positions. Would it be okay to lend them your securities? And you say, well, I don't think it's in my best interest to help people go short stock that I'm long. Well, it's not, and that's why the loan consent form is optional. I just told you that Larry Ellison has pledged his 2 billion shares of Oracle stock as collateral. People were giving him grief about his margin account. He said, I don't know why people give me grief about my margin account. Yeah, I pay close to $200 million in interest charges on the account, but it's not a big deal in my life. And I might want to buy the Lakers someday. So, ooh, Jeannie Buzz, make note to self. Right? What he's going to use is what we call his buying power, right? With that much collateral, he's got all kinds of buying power. You can either use it as cash, SMA, and that's kind of where we're heading. But again, I would be willing to bet you that Larry has not given a loan consent form to Morgan Stanley. I would imagine he said, no, 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 you're not lending my Oracle stock to anybody to establish a short position. Regulation behind the lending. So when you hypothecate the securities to the broker-dealer, the broker-dealer then rehypothecates to the bank. We love margin loans, Charlene, because none of our money's at risk. I'm simply going to take your securities and I'm saying, Mr. Banker, here is Charlene's securities. I would like a loan for Charlene. And that's perfectly copacetic, not a problem. Now, in the next slide, I'm going to show this to you. This is more of a test prep vendor issue than it is for you on your actual Series 7. But here's where we're rehypothecating the loan. Oh, look at that. I got my own picture in there. I didn't know I did that. At some point. Okay, so here's Dean buying 1,000 shares at 40. That's $40,000. My broker dealer's lending me 20 of it. And so my bank broker is going to take 700 shares to Mr. Banker. 140% of my debit balance, 20 grand is $28,000. It's a $40 stock. So, Mr. Banker, here's 700 shares of Dean stock. I'd like a loan for Dean. And Gama was my broker dealer, so it looks like I had some fun with the slide switching around a little bit. But anyways, those 300 shares have to be locked up. Now, the only point here is it's okay to use customer securities to get a customer loan. What would not be copacetic is use customer securities to get the broker dealer loan, right? So, we can only use customer securities for customers' benefit. And to be honest with you, I probably should delete that slide. I just don't think it's important for Series 7. This is very testable. This is stupid, but testable. Stupid, but testable. This is on every exam. SIE, Series 7, 10, 24. I call it the $2,000 trick. So you open a new account, key phraseology you're looking for on the exam, new account. Another phraseology, initial transaction. Right? You say, I wonder if this is this $2,000 trick. This is a FIN rule. This is not the Federal Reserve Board. This is an SRO rule, self-regulatory organization. So I say, hey, you want to buy 100 shares at 18. You say, yeah, Dean, I know how margin accounts work. I'll send you $900. I said, well, if you had an established margin account with me, Charlene, that would be correct. But we have a minimum of 2. He said, well, I'll send you 2. I go, well, Charlene, why would you want to send me 2 to buy $1,800 worth of securities? So the first version of the trick is if somebody buys less than 2, they're just going to pay in full. Second version of the trick, very testable. You say, hey, Dean, I want to open a new margin account. Sounds like a wonderful idea. Buy me 100 shares at 30. I know how margin accounts work. I'll send you $1,500. I say, Charlene, if you had an existing account with me, that would be correct. But a new account, you got to come up with 2. So the second version of the trick is between $2,000 and $4,000, they pay 2. And then the last version of the trick is there is no trick. You say, Dean, I'll buy 100 shares at 50. I know, new account, I'll send you 2. I go, no. Half of 50, 5,000 is $2,500, right? Stupid, but testable. So here we go. Very testable. Customer buys in his initial deposit, initial transaction, new account, 100 shares at 15. We said if he buys less than $2,000, he's going to pay in full. We said the second version of the trick is somebody buys 100 shares at 30. So if it was an existing account, it'd be $1,500. But between $2,000 up to $4,000, it's $2,000. And then we said 50, it's no trick. It's going to be 2,500, right? Because it's greater than $4,000. I call this stupid, but testable. All right, the classical margin equation. I said, Charlene, the best, I think, analogy is a house. The market value of the house minus the mortgage on the house equals equity. Equity represents what you would have if you sold the house and you paid off the loan. Nobody's suggesting you do that. In fact, the bank might even say, hey, you have more equity in your home than you need. You have excess equity in home. We're willing to give you an excess equity line of credit. Now, brokers are very similar, except it's not a house, it's a portfolio of securities. So here you say, Dean, I want to buy 1,000 shares at 40. I say, okay, Charlene, that's $40,000. You want to pay in full? Cash accounts is where you intend to pay in full. And you say, no, Dean, I'd like to do it on margin. I say, very testable. There are certain types of accounts that aren't allowed to use margin, right? They must be cash account, retirement accounts, UPMA accounts, no margin. You say, Dean, I want to do it my margin account. I say, okay, I'm going to need $20,000 from you. We will loan you $20,000. You need to put up $20,000. That's Reg T. That's what I call the initial setup. So in these margin questions, we need to do an initial setup, and then we're going to do a mark to market. Right? Every day is a new day. It's just like a house, right? And the house goes up, down, whatever the case may be. All right, if it goes up, which I'm going to show you next, right? If it goes up, you're going to generate excess equity more than you need. And you can either have that as cash or you can buy additional securities. Our favorite would be to buy additional securities because then we get a commission and we get the additional financing charge. So this excess equity. So let's say now the stock goes to boom, 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 50. And now we're going to do a mark to market, right? So we want to get these right. We do initial setup and then we do a mark to market. Let's put this in test phraseology. Your customer buys 1,000 shares at 40, makes the required deposit. The stock is now trading at 50. Which of the following is true? Okay, well, let's see what would be true. We're going to do mark to market. I call you, I say, hey, Charlene, you have $50,000 worth of securities. You owe us 20. You have $30,000 in equity. You've made $10,000. Wow. Now remember, in the cash account, somebody bought this in their cash account, has also made 10 grand, but remember they put up 40 to make the 10. They made 25%. You put up 20 to make the 10. You make 50%. You're making twice as fast. I say for clients like you that pick stocks that go the right direction, we are willing to advance you a further loan. Now, I always want to compare, I always want to compare what you have to Reg T to see if perhaps we can't loan you some more money, because I know it's one of our favorite things to do. Right? So Reg T, I say, listen, you only need to be at risk for 25 and you're at risk for 30. You have $5,000 in excess equity, more equity than is necessary. I'd like to offer you a loan of $5,000 or allow you to use this to purchase additional securities. You say, well, Dean, I like it at 40, but 50 is a little rich for me. And if I don't do it today, am I going to lose access to this credit line? If I told you that if you didn't use it today, you would lose access to it, you might use it in a way that's not in your best interest. So I say, no. I'll tell you what I'm going to do. I'm going to create a holding tank. I'm going to create a holding tank for your excess equity. I'm going to make a special memorandum to your account that on today you had $5,000 more than you needed. That way you don't lose access to this if the thing goes to 40 again, right? You told me you liked it at 40, but 50 is a little rich for you. So you don't have to do this today if you want. Now, I would tell you on the test, I don't think it's going to be a difference between excess equity and SMA. If you thought of those as one and the same, I think you'd be fine. But then, it's really not the same thing. That's the holding tank for that excess equity. 2 times your SMA is always your buying power. So boom, I'm going to put that there. You can either have SMA, $5,000 in cash, or you can buy $10,000 worth of securities. You told me you liked it at 40, but you didn't like it at 50. I call you and say, hey, guess what? It's back at 40. You told me you liked it at 40. And you say, damn, Dean, I don't have any excess equity. I said, you're right, you don't have any excess equity. Aren't you glad I made a special memorandum to your account? I made a holding tank for the excess. You can still have $5,000 as cash. I think a good analogy here is like your, Visa, where they give you a check and you write it, it goes against your Visa check, right? Or your Visa account. The only person you can't write a Visa check to is Visa, right? If you try and pay your Visa bill with your Visa check, they're going to say, hey, you're a little confused, right? It's like trying to pay down my mortgage with my excess equity line of credit. You're kind of confused a little bit. Anyways, you told me you liked it at 40, so now let's buy some more. You say, yeah, Dean, let's do it. I told you I liked it at 40. Let's buy some more, right? You can buy $10,000 more. And I'm going to show you what that looks like. Again, what we're looking at is the ledger entries, right? Which of the following is true? What ledger entries are affected? And the key on this thing is to do the setup and then a mark. By the way, the vast majority of these questions are going to be like, what can you buy? Margin documentation, because we have a margin department that does this. And the 7 doesn't assume you're going to be a margin clerk, right? I mean, we got people who do this. They, call margin clerks. All right, let's buy some more securities. So here's where your account was. Remember, it went to 50, went back to 40. You told me you liked it at 50, 40. You didn't like it at 50. You thought 50 was a little rich. So you took a pass on increasing your proportion ownership at 50, went back to 40. I called you and I said, hey, you said you liked it at 40. It's back at 40. You said, damn, I don't have any excess equity. I said, you don't need any excess equity. As I said, I don't think on the test that would jam you up. But that's why we make the special memorandum to your account so that you can still use it. So now you buy $10,000 worth of securities using your buying power. You had $40,000 and now you have $50,000 in securities. Now on T+1, we did not use, Charlene, any of your money. We used broker-dealer money. So now you owe us 30 grand. The 20 we originally lent you and the 10 we're lending you now. You had $20,000 in equity. You still have $20,000 in equity. By the way, you said the other thing that you were struggling with is balance sheets, and this is basically a balance sheet kind of a calculation. Assets, long market value minus liabilities, debit equals equity, right? Now we always want to loan you more money, and so we compare, and I say, okay, well, you put yourself below 50%, not a problem. I'm not going to bother you at all about being below 50%. I say, you're below 50. The only new thing for somebody who's below 50% is from here on out, Charlene, I'm going to make you put up half. I'm going to draw your account back to, where it needs to be. And if you sell securities, if you don't say anything, you just say, hey, Dean, I want to sell securities. And you don't say anything else, no problem. I'm just going to pay down your loan. Right? If you say, Dean, I want to sell securities and send me a check. I said, well, did I tell you your account is restricted? Your account is restricted. And you go, no, you didn't mention it. I said, well, it didn't matter till just now. You sold securities, you're asking for a check. You can only have half. You got to leave the other half of the account to pay down the loan. Now, let's suppose that you didn't know that. So you sell securities, you don't tell me any different. And if you don't tell me anything different, I'm just going to take all the proceeds and pay down your loan. That's what I do. As a margin clerk, if you owe the broker dealer money, money comes in to your account, I pay down your loan. If you don't want me to do that, you need to call me and tell me, because as a margin clerk, that's what I do. So, if we have this discussion and you say, well, Dean, I know I can have half, and I'm afraid that if I don't get it now, I might not get it later. I say, well, Charlene, I would prefer as a margin clerk that you leave all the money in the account. And so unless you need that money right now, tell you what I'll do. I'll credit your SMA for the half you could have had and chose not to. That way you can get it later. This is one of my go-to tricks because I just traded you real money for funny money. I traded you real money for funny money right now. The point here is this is the only time that I'm going to make a direct entry into your SMA that isn't a function of mark to market. Now, the other thing, Charlene, this is our coaching call, but I would also tell you there's a tutoring replay where this poor person was doing a past perfect and they wouldn't let her move on to the next unit until she could get like 85% on margin questions. And I call them margin questions from hell. She did give me permission to put that up, and it's called Hellacious Margin Questions. I felt bad because she's paying me, I think I charged 300 now. In those days, I think I was charging 250 or whatever to do questions she's never going to see on the exam.
Right.
So yeah, you're not going to see this on the test. This is a test prep vendor trick, right?
Yeah.
So here we're doing the mark, right? You said, Dean, sell $5,000 worth of securities. You're restricted. I told you as a margin clerk, I'm going to take the proceeds. I'm going to pay down your loan. So you owed us 30, but you just brought in 5 in cash from the sale. You had 20, and I compare it. Now, this is the one time only where in a test prep vendor practice question, you say there's no SMA, because remember I told you I would give you the half. So that's the one time that, you have SMA that isn't a function of excess equity. All right, well, we talked about that. Boom. Very testable. This is recognition. House requirements can always be more stringent. Charlene, I highly recommend if you have some time after you pass your exams that you read both Schwab's memoir, Invested, and Ricketts' memoir. Schwab is the founder, Charles Schwab, and Ricketts is the founder of TD Ameritrade, and his book is called The Harder I Work, the Luckier I Get. Anyways, in Schwab's memoir, he has a vignette of a customer at Schwab who had a margin account that nearly took Schwab under with him. And he said, never again will there be a Schwab customer that, if they go south, is going to take us down with them. And so Schwab has some of the highest house requirements on the street. So the Schwab house requirement last time I checked was 40%. Wow.
Well,
You say you don't like that? What does Schwab say?
too bad.
I kind of think it's like a casino, right? I say, hey, Charlene, your play is a little too strong for us. We'd like you to take your action elsewhere. So the SRO, FINRA sets this minimum, but the house requirement can be more stringent. Now TD Ameritrade and Schwab have merged, And I was reading that there were some TD Ameritrade customers really unhappy because the TD Ameritrade house requirements were much lower than Schwab's. And so I reach out and say, hey, welcome to Schwab. You know, why are you calling me? And I say, well, I just want to go over some of the house rules at Schwab. A little different than what you may have been accustomed to at TD Ameritrade. So I would definitely know that 25. I would definitely know that 30. You say, Dean, how far down could my account go before there would be a problem? I say, well, why are you sending out negative energy like that? I said, at all times to maintain your account, you need to have 25% of the market value in equity. You say, Dean, I didn't ask you what is minimum maintenance. I said, how far down can my account go before there would be a problem? I say, oh, that was on my Series 7. The way we do that is we take what you owe the brokerage firm, in our example, $20,000. We divide debit register, debit balance means the loan by 0.75. And I say, oh, sign of the devil. If this stock goes below 26,666, you're going to have a problem. This is called market value at maintenance. So the reason this is helpful is because we know that if the market value is 30,000, there isn't a problem, right, in terms of maintenance. And the reason this is helpful, we know that if it's 24, there is a problem, right, because that's below 26,666. So I would be able to calculate market value at maintenance, right? And the way you do that is you take the debit and you divide by 0.75. Now, in a brokerage firm, you can borrow money or you can borrow securities. Right? Whether you want to borrow money or borrow securities, you need a margin account. All short sales must be conducted in a margin account. The only time you're ever going to be able to do an opening sale, so Charlene, opening sales are how you establish short positions. The only time you'll be able to do a short sale and not have a margin account is if you're doing an opening sale on a call on stock that you own. Then I'm not going to help you and make you open a margin account. Any other short requires a margin account. So here you say, Dean, sell short 1,000 shares at 32. I say, well, Charlene, I have to call stock loan and see if we have a customer who signed a loan consent form so we can borrow the securities. There is a locate requirement. You just can't sell short. We have a classical short equation. This classical short equation is credit register minus short market value equals equity. Remember, the classical long account was long market value minus debit equals equity. I know both those. And we said the key is to be able to set up the account. So here I'm going to say I need $16,000 from you. Half of 32. You, Charlene, always have to be a risk initially for 50%. So this is where most people get hung up. There's going to be 48 grand in your account. 32 grand from selling the stock you didn't own, plus the 16 I made you put with it. So the credit register credit balance is the cash. This is not free credit balance. This is not cash laying around. It's cash from a short sale. All right, so let's say you want to sell short 1,000 shares at 40. You want to sell 1,000 shares short at 40. So remember, you're going to have to put up 20 grand. So you're going to have 60 grand in cash, 40 grand from selling the borrowed securities plus the 20. The second ledger line is what you owe. What you owe here again is the securities. The equity's 20, Reg T, half of the short market value, perfectly balanced. How often are people perfectly balanced? Day one. Day one. You are a bear. You want the stock to go down. The stock goes to 30. You're a happy camper. I call you. I say, Charlene, you know that stock you sold short at 40? You sold it high, and if you want, you can buy it back today low and give it back to the person you borrowed it from. I'm not suggesting you do that, but right now there's $60,000 in your account, and we could do 30 of it, go buy back the borrowed stock, give it back to the person we borrowed it from. We'd have $30,000 left over. Equity always represents what you would have if you close the account, paid off the loan. Nobody's suggesting you do that. So I always compare what you need to what you have. So you gotta be a little careful with a short account. So I'm gonna compare now because remember, I say for customers like you that pick stocks that go the right way, I'm willing to advance you a further loan. So half of 30 is 15. And you have 15,000 in excess. You say, do I have to do anything today? I say you do not. I tell you what I'm going to do. I'm going to make a special memorandum to your account that on today you had more than you needed. And you can have that as cash. You could sell sort of additional securities. You say, well, Dean, this sounds like great fun. But I'm a little worried. How far up could it go before there would be a problem? I go, well, gee, why you sound negative vibes like that? I say, Charlene, at all times, you got to have 30% of the market value. 30% of the market value, you got no problem. It's not what I asked you, Dean. I didn't ask you what is main. I said, how far down could the account go before there would be a problem? I say, oh, that was on my Series 7 exam. The way we do that is we take the credit register and we divide by 1.3. And that tells us market value at maintenance. And so that's kind of a helpful formula because if we do that, and I'll just take my calculator here, 60 divide by 1.3. I go, if it goes above 46,000, 153.85, you're going to have a problem. Right? And right now you got no problem because, yeah, the short market value is 30. So kind of nice, right? Because if we know that, it's helpful for us in terms of seeing where this account's at. Oh, look at this. We said this is kind of helpful. Do we know that there is a problem with this mark to market at 50? Do we know that there's a problem? We do, because 50 is above 46,853. Right? That's why that was kind of helpful to do that. So I say, Charlene, 60 minus 50, 10. 30% of 50 is 15, and you only have 10. So you have a maintenance call of 5,000. Oh, you say, Dean, T plus 1 plus 2. I'll get it to you. I go, what are you talking about? And you say, well, under Reg T, Dean, I get 2 additional days to meet a margin call. I say, Charlene, this is not a margin call. This is a maintenance call. Maintenance calls are due promptly. I'll never tell you what promptly is because I want to say that wasn't prompt enough. As I said, the reason we know that that is a problem is because we did our math here and we knew that any number above 46,153, 84 was going to be a problem, right? Here is our classical equations. Remember this from grade school? You can combine like things, right? So long market value minus debit plus credit minus short market value, gives us combined equity in this account of 31 grand. We spent about 38 minutes in this coaching call going over margin. I have margin class replays, Charlene, you can watch. I have tutoring margin replays you can watch. I just be careful. In fact, my margin